Maybe. Yeah. Harshit, go.
Good afternoon, Nicole. Good to see you online.
Thank you, Harshit. Good to see you too.
And we have Puru as well. And I hope you know Puru.
Absolutely. Who
Of
doesn't
course.
know?
And Nicole, I do remember I had a privilege to visit your chapter. You're part of BNI chapter, and Puru invited me, and I saw you as a vice president. How do you see your BNI journey?
My BNI journey has been amazing after the last 6 years. The
Wow.
connections that I have made along the way has been absolutely exceptional to my business, but also to me personally. We've made some good friends and that along the way. But yeah, just those connections to help my clients and things like that, it's been exceptional.
And I could see that energy because I saw as a vice president the role that you're playing. It's more of like a family,
Yeah.
and I enjoyed being there because I'm part of Ringwood PNI chapter. So and that was amazing. And Nicole, since I got you here, we have done Q and A's with different people in real estate, especially for investors. The purpose, the purpose. You're a member of our group. You know what we do. The intent was we have done it so many, and a lot of questions came in all our sessions related to accounting, right? Because we always talk about structure, whether it's mortgage broker or anything. So, how long you have been in this business and what you do, where you are, what are the key differentiations? So, a bit about you, Nicole.
Yeah, so I've been an accountant now for 26 years. So been around the industry for quite some time. Started off straight out of university. I am a fellow of the CPA, so I've been a member of them for just as many years. And I'm the director of Negotiis Advisors in the Point Cook Town Centre there, so just on the townhouses. We do all sorts of accounting. So we work on your individuals and rental properties and things like that, because I have a very big passion of rental properties, and work all the way through our business structures, small, medium, and large. So a lot of international companies and things. But I guess one of my point of differences, whether it's an individual or a business, every client to me has a value and has something that they want to hit as a goal and somewhere they want to be in the future for retirement. And that wealth creation is something that's really important to me that I really focus on. Doesn't matter how big the client is. It could just be a mum and dad that's working and they want to build a portfolio or they want to build some wealth creation outside of super. It could be a multi-million-dollar business that wants to also grow their personal and their business wealth. But the other little difference that I have against a lot of accountants is the protection of that. So we want to make sure that not only do you accrue your wealth, but along the journey, there's so many risk factors when you have some sort of investments that they're all protected along the way. So asset protection is very, very important and very big to me, and to make sure that what my clients are working so hard towards is they're protected in the long term and there for their legacy and their bloodline.
Wow. And you know what? These all are music to my ears. They're amazing because of the bias agent, the strategy, right? So it's all comes under strategy. It's not about short-term goals because whatever you mention gives me a view. I paint a picture when to engage you. It's you are not looking at the short term, you're looking at long term. And I believe that it's more about a partnership. You're not just a typical tax advisor, you are a partner in the journey for wealth building. So and that's where the game changing happens. And you talked about generational wealth as well from the perspective for the family and long term goals as well, whether it's business, individual. And what I got from your introduction, Nicole, is you emphasized on individual goals. It means it's not just about how many millions are in the business accounting, what you're doing. It's more about helping people, guiding them, coaching them, and being part of the journey. That what excites you. Um, and just on that, Nicole, do you have any recent story that would you would like to share in which how engagement with you has been a game changing experience for your client? You may have multiple, but I would like to. I'm keen to hear something on what you mentioned.
Yeah, so I do have multiple strategies and there are multiple good stories that in my long-term industry. But I think one of my most memorable is I had a mum and dad that were average workers at the time, and they came to me and they were middle-aged, and they said, Nicole, I've left it too late. I can't get to where I want to be in retirement. I'm going to have to go on the pension, and I just don't know what to do. And by putting a strategy in place for them and getting them to think outside the box and educating them on what they can still do at their age, they were able to build a portfolio. They diversified. They do have properties and managed funds now as well. And they have a really nice super balance. But what we're able to do is really get them to start thinking out the box and using their good and bad debt strategies to build that wealth. Now, they're now sitting on a portfolio of about $2 million. So over a period of time, as you said, it's not a quick fix. It's a long period strategy. But if you have that right advice, your long-term goals can come a reality quite simply.
And that's amazing, Nicole. That's a great story, because we see people, the stress in people who are entering towards retirement, and now they're wondering the cost of living then. So this is great. And one question that comes in, because you use advice word multiple times and financial planning, how do you differentiate your services as a tax advisor versus a financial planner? So
it's a really good question, and it's one that I get quite a bit. I am not a financial planner. Yeah. So I'm not licensed as a financial planner. I can't give specific advice in relation to shares, managed funds, and things like that. What I can do is give you the strategy to use and then connect you to the appropriate people that you need to build that strategy. So I can tell you the tax consequences. I can tell you the structure to go into. I can tell you what it's all going to mean in the long term. Then we find you somebody to strategize to bring in those investments, whether it's property, managed funds, ETFs, Bitcoin that people love so much, all these different strategies. We connect you to the right people that can help you build that.
Wow, similar to it's all the function of a financial plan, because they are the subject matter experts. Similarly, if it's a property portfolio, you will be connecting with people like Puru, Anubhav, or me for that sake as a buyer's agent who do property day in, day out, right? So what can be done in that structure?
That's absolutely right. So whether they haven't got property and they want to start investing and they want to start exploring that avenue, Peru would be the ultimate person to get that strategy, because it is all about strategy. No matter what you do for your goals, at the end of the day, it's all about getting that strategy.
Wow, I love it. I love it. It's getting exciting. And I could see some of the questions. And since with your depth, I believe we have the right question here, which is very common. Even I'm keen on, because I pay a lot of taxes. I used to. Now now I have a strategy. I have the right people on my side to help me. So this is a question from our audience. It is, what are the most tax-effective structures for property investment? Like, personal ownership, company or trust, or SMSF. So, and how do they impact tax liabilities?
Great question. So obviously, depending on your personal situation, things can differ. So it's really important to get the advice up front that suits you and your end goals. But in general, if we're talking structure, we normally go down a family trust type structure rather than a company. The reason I do that is there's flexibility if it's what we call positive geared. So you might not have as much borrowing against that property. So it's actually making you money. A prime example of this is probably a B&B type arrangement and things like that are normally profit generating. You can split that income to family members and the likes rather than having it in your own name, paying tax on it in your own name. A company, when you go to sell it, it's one big thing that people worry about with property is what happens when I sell it in capital gains tax. A company doesn't get some of the concessions that a trust gets. So that's why we sort of steer clear away from companies alone, and we'll go through a trust structure. But I think one of the biggest things I say to my clients, and more my small business clients or my sole traders and things like that, I normally start with a question to them of what's more important to them when buying property or any sort of investment. Minimizing their tax situation, which is a big one for everybody, or asset protection, because they are two very different questions and have two different results depending on which way the client goes. So now you can probably start to see why it does differ between every individual, because some people say to me, Nicole, save me tax. and we can turn some good debt into bad debt. And I'm sure that's going to come up later in this conversation. Or people might say to me, look, I'm looking at going into a business later on. I want to protect everything that I'm earning right now. I want a structure that has the asset protection. Because being an individual name might not be the best for that strategy. So it really does depend on what your end goals are to what structure you go into. But then you can't forget the ultimate self-managed super fund structure. So setting up a self-managed super fund with your super allows you also to buy property in that self-managed super fund. Rules and regulations galore around it. But again, if you get that right advice right up front, you can make a perfect strategy and build a nice portfolio in self-managed super funds. And the tax effectiveness of a self-managed super fund, you can be paying as less as 15% tax.
Yep.
Wow.
And we are seeing a lot of inclination because almost 30 to 40% of our existing investors, they are asking us question that, hey, what can I do with my SMSF? And we refer them to the right subject matter expert like you or the financial planners to set up their SMSF and seek their advice. And when it comes to property, whether it's commercial, because we are seeing a lot of inclination towards commercial investments as well under SMSF, as you will know the reason. So, but yeah, and you mentioned in your introduction as well about good debt and a bad debt. So I would like to know example of, in definition from tax perspective, how do you see what is a good debt example and what is a bad debt example?
So the first thing we sort of go to when we talk good debt, bad debt is the tax deductibility of that debt. So your own home, for example, your owner-occupied home or your primary place of residence, there's no tax deduction or shouldn't be a tax deduction in relation to that type of income because that is your main source of your asset. Your primary place of production, your primary resident can be anything from your biggest asset that you own. So you want to protect that from a tax perspective. As soon as you start working at home, you want to start claiming some tax deductions around that. You have the possibility of bringing capital gains into your biggest asset later on, and you don't want to do that. So that type of debt, so the interest you have on your family home, we call that bad debt because you cannot claim a tax deduction for it or should not claim a tax deduction for it. On the flip side of that, if you want to buy an investment property that's generating an income in your income tax return, that interest is now deductible. So we call that good debt. Because what happens is, in the ideal scenario, we have some negative gearing effect, which means that your expenses outrun what your income is for that property, giving you a tax deduction on your tax return, which in turn gives you higher refunds. The strategy we normally use there is those additional refunds goes to pay off your primary place of residence a lot quicker. And that's one of the strategies we put in play to try and get rid of some of that bad debt while maximizing the good debt.
Wow. Quite interesting. And I believe this was quite insightful for everyone, for a common person to understand, because yes, in the taxation terminology, because we hear this generically, good debt, bad debt, from mortgage brokers, from bankers, and in general, social media people, but nobody explained it this way, how to differentiate what. And to be honest, everything that you said till now, you always mentioned about strategy, and I believe strategy is all about it's tailored to the individual requirement, right? And so applies for negative gearing as well, because not every time negative gearing is bad, right? So as I said, that whatever you're saying, it's about individual circumstances. You assess that, you create a tailored strategy. So what suits me may not be applicable to Puru or to anybody. And also the strategy, do you review the strategy or it is just static once you have said, just that's your Bible? Is that something, or you review it in
No.
your and accordingly manage?
Yeah, it needs to be reviewed on a regular basis. We normally review all of our clients in 12 months. So we watch where they're going for the next 12 months, analyze and we guide them, and we keep them accountable too, because a lot of people at the start of the year, it's like in January, they've got New Year's resolutions to do all these things, and then 2 weeks later they drop them all. What we like to do with our clients is get them to document where they want to be, and we really monitor that progress over that 12-month period. And if they aren't keeping accountable to their goals and what they want to do, we really hold them accountable and say, well, why not? What's happened? Where's the mindset change? We bring them back into that mindset of we can do this. Once we do that, they take off like a rocket.
Wow. So you do a lot of motivational stuff as well.
Absolutely. If you tell me you're going to do something, we make sure that you do it.
Oh no, perfect. And that's
and Harshit, just so you know, Nicole is a prolific public speaker as well. In fact, she was telling me she's going to the US very soon to address around 5,000 people. Is that right, Nicole?
Yeah, so in about a week and a half, I'm heading over to America to do some public speaking in front of about a 5,000 people stage. So it is quite exciting.
Wow. If it's related to tax or property or something, we will love to get a bit of video link or something later on posted to the group. That will be great for our audience.
Yeah,
And
absolutely.
Nicole,
I've actually got a couple of videos I've done throughout the last 12 months.
Okay. That will be great. If there are information related things, we'll love to see them as well.
and questions have started flowing in, Nicole. I think I have to just go with the flow because there's so many. And as I was suspecting, there's a question: how can negative gearing be utilized effectively for tax savings? And what are the risks associated with it?
Good question. So the risks associated with negative gearing depends on the individual. So if you're an individual that has a small business and something happens to that small business, any assets in your personal name can be up to grabs for any creditors and the likes. So we normally sort of say to people, when you're looking at a strategy between a family, to a husband and wife, or two partners, or however your family structure is, we normally say one is an asset holder and one is the risk taker. And what we normally do is the asset holder holds all the rental properties and the risk taker has the business. What happens in those situations is if something happens to the business, the assets that you've worked hard for are still going to be protected in that sense. So the risk can either be a business risk from sole traders. It can be family law risk as well. In case of separations, it's normally investment properties and things like that's forced to sell or they separate in the family law treatings, and or the risk can simply be income and you can't tenant that property. So it might be in the wrong area. You might have gone off the cuff and just found a house that you liked and your emotions have kicked in, but it might not be in a real good area, tenant, but that you can't tenant. So it's these sort of things that the risks can pop up, that if you get that right advice to begin with, they can eliminate 90% of those risks. Make sure that it's structured properly in the right areas, and that does eliminate a lot of that.
Quite insightful, and I think that's perfect. In the thing that always Victoria being very dynamic with laws and everything, and next question is related to that. Are there any upcoming changes to property tax laws or regulations in Victoria that investors should prepare for?
There's always conversations, and unfortunately in the tax world, one of my common sayings is, as per the current legislation today, because any time that tax legislation can change. We have heard on the grapevine are looking at changing negative gearing, disallowing the tax deduction if you have two or more properties. They are looking at changing the CGT discount and eliminating or reducing in certain situations. Unfortunately, none of that's been concrete yet. They have tried a number of times over the last few years to do exactly the same thing and never got it up through Parliament. So unfortunately, it is a watch this space. They are always trying to tinker with certain things in the tax legislation. Property is on the chopping board again. but I'm not going to hold my breath that anything's going to change too quickly.
Wow. That's good. That gives a bit of a relief. So while we are talking, nobody is changing any of the laws, right? So that's at least whatever for next 30 minutes, 30 to 45 minutes, things are status quo.
No, as we
That's
speak right now.
Yeah, and that's quite.
That's
And
right.
I have
As
this
we speak now,
question.
negative gearing has been left alone. Capital gains taxes still got exemptions, so we're still good to go.
Yep, and that shows the curiosity and anxiety among the investors. That question, this is a bit long question. I'll just read word by word so that it doesn't, so that it means the right way. In properties within 12 months, what is the best structure to save on tax, company or trust?
I missed the start of that question. Was that if I hold it longer than 12 months?
Within 12 months. When flipping properties within 12 months, what is the best structure to save on tax, whether it should buy under company or trust? And on top of it, one more question on top of it is, what's the difference between the two in terms of setup fee and ongoing cost, and if any difference in the tax rates? So it's a very long question, but related.
It is, but all good. I get the gist. All right. The thing with property to remember, as with any investment, if you hold it for more than 12 months, there's a CGT discount that can apply. Okay. So which means whatever your capital gain is for that, let's talk property, whatever the capital gain for that property is, and you hold it more than 12 months as an investment, you can get a 50% discount on your capital gain. So you divide your gain by 2, and that's what you pay tax at. The problem with that is you don't get that if you're a company. Okay, so it really will depend when you're talking structure on what type of property you've got. The reason a trust doesn't get that 50%, a company doesn't get that 50% discount is that their tax rate is capped at 25%. So you can make $1 million worth of profit on a property and you're only paying 25% tax in a company, where a trust needs to distribute that to certain beneficiary and they're taxed at their individual tax rates. So I can't really give you a specific answer without knowing, if it's a trust, who our beneficiaries are and what their tax rates are and things like that. But to answer it in a roundabout way, a company is taxed at 25% flat rate. Doesn't matter if it's $1 of profit or $1 million of profit. A trust, you have flexibility where you can distribute that money down to family members as long as you make an election to bring it into the family group. And as long as that's done properly, if you've got people that are on any income, on low incomes, maybe they're students over the age of 18 with no other income and no Centrelink benefits, it could be a mum and dad that's a self-funded retiree and they can get the additional income. It depends on what all those people are on to what tax rate. It can vary to 17% tax rate right up to 50% tax rate. So again, this is where it depends on the individual situation to how we set it up at the beginning.
Yep. And the difference between setup fee and ongoing cost, company versus trust?
Yeah, so for a company, you're looking just under $2,000 to set up a standard company on its own. To set up a trust, I always set it up with a corporate trustee, and that's for protection purposes. So you're looking at about $3,500 to set up the company and the trust and have all the appropriate document in place for that structure.
Okay, that's good. I hope I will. If I get further questions, she will reach out to you because your details will be shared when we publish this reel. So the next question from the same audience is, how can you get the profit out of company if one pays 25 to 30% tax for the company and then pays themselves as director? The profit shared wouldn't they pay tax difference on top anyways? So what's the benefit of company or trust when flipping within 12 months?
It's a hard question to answer without knowing the individual situation. So the basic question is the first question I heard there was, how do I get money out of a company? There's only two ways we can get money out of a company. That's via wages, whether it's directors' wages or wages. If you've got a company that only holds property, paying wages is going to be difficult. Or two, by a dividend. So paying a shareholder dividend out after you've paid some taxes. So depending on the taxable income of those people, if it's, for example, a shareholder that's under $80,000 of income and we pay them a franked dividend, so taxes paid already from the company comes down to your shareholder, in certain structures and certain strategies, there is actually a way you can get a refund of some of that company taxes in your personal return. Really depends, though, on what your personal income is at the end of the day. Because if you're on a higher income, you're right, there's going to be top-up taxes no matter what you do.
That makes sense. And as you said that, I hear it. It's about the individual. So I believe I would request member of the audience to reach out to you directly and discuss this question related to how it impacts him or her. And just on, since you mentioned CGT.
Definitely.
So now I've got some questions on CGT. How can I minimize my capital gain tax when selling an investment property?
Okay, great question again. And I'm going to say it depends. So if you're an individual and you're selling a rental property, there's many strategies that we can do. We can put money into self-managed super or your industry super fund and get tax deductions from that in certain instances. That will reduce your capital gain. We normally say to people, if you have to do work on the property, do it before you actually sell, because the capital works that you're putting into that property will reduce that capital gain as well. And then we always make sure that the strategy that you put in place is over that 12-month period, so that your capital gain at least will get a 50% discount if it's in an individual name or a trust, or a 1/3 discount if you're dealing with a super fund. The other reason I like super funds for long-term investment is the whole idea of turning that pension self-managed super fund into a pension phase when you hit some certain criteria, and then selling the property, because what that means is that capital gain then becomes tax-free in essence in some circumstances. Again, you'd need to have proper advice at the time, but we've done many strategies where they've done that. They've purchased properties for long-term investment, 10, 15 years, held them all those times. They've got into pension mode. They've sold the property. They've actually paid no capital gains tax at that point.
Wow. Brilliant.
Did you say no capital gains tax? Did I hear no capital gains tax?
You heard that right. In certain circumstances, if it's structured correctly in a self-managed super fund, there can no capital gains tax.
Harshit, if it's okay, I have a question too, because whilst we are talking about a little bit about trusts and other things, so is there a indicative general suggestion where if I am a couple, what sort of combined salary I should be on before I decide whether I should buy property in our direct names or a family trust? Because there is a cost perception about family trusts, which sway people away from it, right? Because they say like our rate of saving is only 3,000 a month as a household, and then if we put on more, which is like if it's operating expenditure of the property while we are holding it, and then there is more family trust costs, etc. It's just eating into our lifestyle right now. So it's, whilst we understand the benefits, we don't have any other business, we are a younger family. So again, individual circumstances I understand, but in your mind, is like once you cross 200,000 is a good number, or 150,000 is a good number, some sort of indicator number?
I lost that last bit of the question, Peru. So what was that last little bit of the question?
Yeah, the internet is a bit choppy.
So I
My
got to up to
apologies.
incomes of 200,000. What did you mention after that?
So once I cross a $200,000
Yeah. No, that's okay.
income
So when
bracket,
it comes to when I think, yep. Yeah. So what I normally say to clients, depending on their income, I wouldn't say you have to have a $200,000 income combined to start looking at your strategies and things like that. It comes down to serviceability, and I know you've had Matt on recently with mortgage broking and looking at serviceability and things like that, which is really important.
yeah.
But if you've got a strategy of property in mind, starting to talk about it and working out what you need your income levels to be at a certain point is more important, I think, than waiting till you get to that income level. Because in a lot of my cases, I've had some middle range income families go into property, brand new properties, for example, and it's really only cost them in the right areas with the right tenants about $20 a week. So even though the cost of living is really tricky now, if you get the right strategy, right property, right area, and the right advice, some of these properties don't actually cost you a lot of money. If the property is tenanted, it's covering all the costs and things like that. We get depreciation schedules, which minimizes or the maximizes the expenses and things like that. And we do all the tax effectiveness structures. A rental property may not cost you as much as you think.
That's so true. It is about the right asset at the right price, right timing, which can make the difference in the choices you're making. Yeah, but it's good to know. I mean, roughly 200K is a decent number to start looking at these things, which is a good guiding sort of number to consider it at least. Because I know family trust
Yeah.
introduces um, lower borrowing capacity in some cases. Land taxes are calculated differently. But again, we don't want our investors to be penny wise, dollar stupid in the long run, which I've seen many times. Unfortunately, they can't do anything. They buy assets, and when the capital gains grow, uh, they just want to sell the property and take the profits out. But they've distributed 90% in the higher income person's name and 10% in the lower income person's name, and then it it comes and adds to their overall package for the year, and then they just don't have any way to save the capital gains. It has happened to so many investors, and there's no way to save that money then.
And this is why it's important, Peru, to get that structure right at the front. Because if you go into a strategy saying, I'm just going to do this personally, I'm going to do this 50-50, or I've got a lot of clients that come in and they say to me, I've bought a property, I haven't told you, and it's 99 to my husband and 1% to me. So the idea is great. But what happens is they then go and sell it at not tell me. They have got tax, a tax bracket of $150,000 to $160,000, and 90% of that capital gain is going to go to that taxpayer because they haven't strategized or they haven't thought about when they're going to sell that property. They've panicked, they've sold it, and they haven't looked at the consequences. We're in the situation like that. If we had sat down and structured it properly to begin with, went through the pros and cons of having it in 99 and 1%, they probably wouldn't have chosen that, or they would have held it and not sold it until a later date. Because once you go into pension mode and things like that.
Yeah, and it is such an important point, and thanks for bringing it up. People do not plan selling their properties properly, even their principal place of residence, their investment properties, because they just get a trigger based on the market conditions or life needs. And I understand all of that. But to talk to an accountant or a buying agent who has served in the first place can really help you plan, optimize your taxes in the right way. And it saves so much of your effort as well later on. So thanks for
And
bringing that
so
up.
much heartbreak.
Oh,
The
tell
amount
me
of
about it.
people that I have had to deliver. Yeah, I've had to deliver a huge tax liability, which could have been avoided if they didn't panic and they just talked to the appropriate people they needed to. There's so many stories like that I have.
So one of the trends is within Point Cook itself, I have seen it with few of my friends. They upgraded from a single storied home to double storied home, and then they didn't realize that they can optimize their capital gains by declaring the principal place of residence and rental place in such a way. Any lights you want to shed on that sort of strategy or concept so that people can at least know about it?
Yeah, absolutely. So one of the biggest things a lot of people don't realize is the 6-year rule that's out there for your property, your main place of residence. And this rule is predominantly for people that travel a lot. So your police force, your military, and things like that on regular postings every couple of years. So the content is around you buy your own primary place of residence, you live in it for a couple of years, and then your job says, right, we're going to post you for a 2-year posting interstate. Now, the ruling basically states as long as when you move away and you don't have another property place of residence in your name at all. So when you move, say they send you to Sydney for 2 years, you go to Sydney and you rent in Sydney, you don't own a home, you can rent out your current principal place of residence here, say in Point Cook while you're away, rent it out, earn an income. So somebody's paying your mortgage. It will not attract capital gains as long as you move back within 6 years. So if you're on a 2-year tour away, for example, and you come back after that 2-year period, you refresh that 6-year rule, there's no capital gains if you sold that house tomorrow.
This is powerful because really what you're saying is, from the definition of your principal place perspective, within the 6 years, and how long you have to stay before you sell it again. Say if I move back in the 5th year of 5.5 year, is there a requirement to stay in the home for more than 3 months, 6 months, 12 months? What is that?
No, you just need to move back in. So
Okay,
we've had a case and it went through an 18-year review. Yeah, so we moved back in, we moved back out a week later, and it refreshed the 6-year rule.
Oh, wow. That is very interesting. Very, very interesting.
Yeah.
Harshit, over to you.
Now,
I'm sure there are
obviously,
more
you can't
questions.
do it.
Yeah. Sorry, go ahead.
Yeah, you can't do it over and over and over and over again. Obviously, the ATO will start getting ideas that something's not right. But Defence Force members, for example, they do move every 2 years. So, and they don't always come back to locality. So in certain circumstances, it can apply for a lot longer, as long as you come back and move back in to refresh that rule.
And it's common in IT as well. People do move between cities and countries. It's not too uncommon. And I guess I understand that the rule is to support the people with those situations rather than to really make misuse of it, right? Harshit, you might have more questions.
Oh, yeah. A lot of strategy and long-term investment questions. Yes. Now I'm getting questions from normal people, salaried people, and related to property investments. So, what expenses related to property investment can be immediately claimed as tax deductions, and what requires depreciation over time?
Okay. So, anything, if you've got a rental property, any costs that you have associated with that particular property can be a tax deduction. So, your rates, your water, your insurance, your landlord insurance, any repairs and maintenance to the property. The only exception to repairs and maintenance is we need to be careful what's a repair. So putting something back to the original state to a replacement. So that can be a gutter replacement and replacing it with a new product to make it bigger and better. That's not going to be an automatic tax deduction. That's going to be written off over a period of time. And then we've got tax rulings to how long that can take. But if the important thing to remember is it is a tax deduction. The big one at the moment is your land tax on that investment property is tax deductible, and in some instances that's quite large. Any expenses whatsoever, your interest, anything that you spend on that rental property is a tax deduction. Now, depreciation, what I normally say is if you're buying a brand new property that no one has ever lived in before, so builders have just built it, you then decide to buy it and move in or rent it at the end of the day, you can do a depreciation schedule on that. And what they'll do, so there's many organizations, we personally use BMT, but there's many organizations out there that do these reports. And from an ATO perspective, they give you all the tax deductions you can claim for inside the property and the structure itself. And that's guaranteed from an audit. So as long as you're using those reports, you're going to pass an ATO audit without a problem. The only problem when you're buying established homes is you no longer get the insides of your property as depreciation. You only get the shell and the structure on the outside. So sometimes it may not be worth going down the depreciation path, but it's always better to ask an expert. This is the age of the property. This is what I've purchased. Is it a good idea to do this schedule or not?
Okay.
And
I have a
did you
question
say?
just on that. Sorry,
Yeah, go ahead, Harshit.
Uh,
Sorry, I'll
my
go ahead
question
then.
just
There is a lag in the video, so I couldn't pick up the timing of your question. So I'll finish it. So the principal place of residence, you said that can also be asked in depreciation schedule.
Primary place of residence, no, not normally.
Okay.
If you're applying the 6-year rule, then it could be something to look at. But it depends on how long, whether to pay the cost of the report, the benefit you're going to get, that's what we sort of look at. So sometimes, yes, it is worth doing, but it's predominantly for your rental properties, your residential rental properties predominantly.
Okay, got it. Over to you, Harshit.
Yep. I have a tricky question. Nicole, suppose I'm seeing this as a pattern because some of the groups, family, social, drinking, birthday parties group I go, a lot of people are conversing because now I'm a bit educated on real estate, thanks to FMRE, thanks to working with professionals, BNI. I keep hearing, I get educated. Every minute I learn something more. I hear off talks like, and then people say, hey, I was chatting with my tax advisor, and they pay some, they don't understand difference between a tax advisor versus just a tax filer, whom they pay $90, $120, $160 just for filing the tax in an Excel sheet. And they said, okay, I'm thinking I will save around 15,000, 20,000 tax per year if I just buy a home and land package somewhere nearby. So do you hear these kind of queries generally? And because I'm curious about property investments perspective, a lot of people are misguided or their DIY options there, thanks to the Google as well. They research, depreciation, negative gearing, that will help me save taxes, and that's it. And they're very much addicted to that $15,000 tax savings rather than looking at the opportunity cost and the bigger picture. Do you see these type of clients regularly?
Every day. So a big, yeah, and don't get me wrong, there is a lot of property owners out there that can get your $10,000-$15,000 tax returns in a 12-month period for a brand new rental property, because the depreciation and all the costs that they are paying can give that sort of benefit. Normally not the first year because everything's prorated unless you do it in June, but definitely that second year, I've got a lot of clients that do get that sort of return. But is it the right strategy for you? You've got to weigh that up. And again, you're buying it in your individual name. So what's the capital gains going to look like later on that you're going to pay taxes on? And can you strategize to reduce that enough? Because it's okay getting these tax deductions along the way, paying off your home loans and things like that, which is great. But if you sell your property and you've got to pay it all back to the tax man because it hasn't been strategized properly, that's where I have a problem. So absolutely, I see all these people come to me and go, wow, you've got me a $15,000 refund, which is great, but they're not looking at that long-term picture and what the consequences can be down the track.
Wow, Nicole, that's something very, very powerful. And I would love this because coming from straight away, you who has been in this industry for 20 plus years and know the pattern. And as a buyer's agent, because it's a friendly thing, I say, hey guys, go and talk to what you're thinking, whatever you are Googled. I'm not a tax advisor, neither. I'm a buyer's agent. I know how to buy properties in the right structure, but go and have a chat. Something is wrong with your thinking. And that's how I just leave it there because I just can't take them to a tax agent or whatever. But if I hear that chatter anyway, I will definitely send them to you because this
And the
needs
other thing you
a lot
said,
of
Harshit, which is
education.
really, definitely, which is really important as well, is you mentioned at the start the differentiation between a tax agent and an accountant. So one just will file your tax return. They don't really give you strategy. If you want the strategy side of things, you really need to pay for the tax advice you're getting from a CPA or a CA accountant, not just a tax agent. A tax agent can lodge a return and charge you $99, not a problem. But what they won't give you is that little bit of extra advice of what it means at the end of the day for you, and strategize that tax planning and analysis over a 5 to 10 year period.
Yeah.
Wow.
And I would suggest people online, if there are any questions regarding commercial property buying and taxes related to them as well, specifically with some variations, please do post here, because that's another variation to the whole thing. There is a question sitting in the chat. Harshit, I'll just read it to Nicole. Can property ownership ratio can be changed during the ownership period?
It's a really good question, and I get this quite a bit. And unfortunately, the answer to that, well, you can is the answer to that, but you're going to hit capital gains. So once an investment property is in the name, and we are talking investment property here, of 50-50 or an individual's name, to transfer it to somebody else, there will be capital gains tax, unless it's a family law situation or it's a primary place of residence and you're transferring it to your spouse for love and consideration. Then we can get around those rules. But for anything else, if you've purchased a property 50-50, 90-10, 100%, it needs to stay in that, because as soon as you change it, you've got capital gains consequences.
Quite good.
Yeah, quite insightful actually, because yeah, again, it's a very individual circumstances. When you have to sell, you have to see how much work I'll be doing this year. Am I planning to take a break or whatever? Those are the good years to sell it if you want to really salvage the situation. But then again, I'll leave it to the expert to really tell them.
Yeah.
Harshit, over to you. We have another 12 minutes as a time check.
Yes, and some of the things that, yeah, we talked about mistakes, right? You leave it to the last. And now that's why people are asking now, what are some proactive tax planning strategies that property investors should implement before the end of financial year?
For existing properties they own? Is that the question? For if they've got existing properties?
I would like to keep it for both, because I don't know what's the intent of the audience. So
Yep.
I would leave it for both. Yeah.
Okay. So if you don't have an investment property, then something to think about for the next financial year. Something to remember when you're dealing with property, it's not something you can go and do tomorrow. It takes a period of time to get these things sorted. So the quicker you start talking about these things, the better it's going to be. So for property per se, unless you've already pre-strategized it, it's not something that you're going to be able to jump in for the very next day. If you've got existing properties, what I normally look at is, are your properties negative geared or positive geared? So are they making you money, or are they the other way around, and they're creating that refund for you that we want against your income? The reason I'll say that is if you've got positive gears property, you more than likely have equity sitting in those properties that we can look at refinancing, getting some of that equity out to purchase another property that could be negative geared to take away that positiveness of the other properties. So it really depends on which way the person asking the question has in their situation, if they're an existing property owner or if they're looking to get into the property market.
So just on that scenario, just to elaborate that. So suppose if you have a property under a family trust, you have one property negatively geared, which is your residential, because most of the residential are negatively geared, thanks to the government policies and the high interest rates. Yep. And then you buy a commercial property, because we are getting a lot of inquiries towards commercial as well, because people want cash flow. Cash is king always. So now you buy another commercial property. Suppose you're 20K negative and you buy a commercial property with 25K or 20K. So that negates the, and does that increase their borrowing capacity as well in general? You know, how does it work?
Yeah, it can. So if you've got equity in one property, we normally say use the at least 20% equity to get the deposit for the next property. And then 80% of that property can then be borrowed, and you're 100% borrowed for that next property, if that makes sense.
Yeah,
What
perfect.
I
Got it.
don't
It's
normally
more of a
get people to
mortgage broker
do
question.
is, yeah, it is a mortgage broker question. But what I don't normally try to do is use your primary place of residence as that borrowing property, because you want to keep that unencumbered as much as possible.
Perfect. Now, this is great. Now, next on something on cash flow, because we do implement some different strategies, rooming house, commercial, or Airbnb. So, this is from our client. How do tax laws in Victoria differ for short term renters like Airbnb or rooming house compared to long term rental investments?
The only big difference is that the ATO will see an Airbnb like a business, where it's still residential investing per se, but I do have one client that operates out of a family trust that has multiple, and I mean a lot of Airbnbs in the one trust. And what the ATO sees him as a leasing entity. So we've classified him as a small business and not as a investor. In those type of situations, if you're doing it on a multiple and we can classify you as a small business, there's some other concessions that you can get with CJT that eliminates some of that tax later on. But there's only specific situations where that would apply.
Yeah,
Interesting.
and that's the interesting thing you brought up. Especially, we haven't touched a bit on the other real estate professions like trades, builders, and developers. Their tax planning is also important because they do not sometimes understand the joint ventures they want to do, the syndicates they want to run, the other structures like unit trust, joint, because again, they haven't thought about it. They don't engage the right advice at the right time. And trades, for example, they want to save their tax all the time. There is a lot of parallel cash uh, economy, which is open, like it's a white elephant everyone knows about, but can't do anything about it. Like people want to save GSTs and all that. But again, then later on, they do not have good books to show to the banks and they can't get loans. So, do you get that sort of question coming your way all the way? Because there might be few audiences of those backgrounds, they might want to get a good message from you here.
Yeah, definitely. We have a lot of small businesses that do want to go into property and things like that. But because we do tax planning, and a lot of the times they don't voice that they want this type of strategy. So our goal is to minimize what taxes they're paying to the taxman as much as possible. And sometimes with a small business, we can go right down to paying virtually no tax at all. The problem with that is as soon as you go to the banks are going to say you've got no income, you've got no serviceability.
Yes.
So this is where it's really important with our trades and things like that want to have these strategies in place, that they communicate that to us as well, so we can make sure that we put tax planning strategies in place for their business that's not going to affect the banking scenarios and things like that.
Yeah, and that's so true. I mean, they then have to go through different types of private lending loans and whatnot for buying basic stuffs like
Yeah.
cars and doing all their own investments. Even the scaling is a challenge because they just don't have the opportunity to loan it out in a proper way. Harshit, we are now 5 minutes. So if there are a
Yeah,
few
I'm
more
going to
questions.
ask her one of the toughest question, which I have never asked to any of my people in all the Q&As I have done.
As if you haven't asked any tough questions. Nicole can't wait to get off this call and have a dinner or a wine, I guess.
Now, so Nicole, is there anything that I have not asked to you? You were anticipating that question from me, and you would like to answer for my audience. That's my toughest question.
That is a tough question. And the only reason is because we have covered a broad range of things. And I think, look, apart from everybody is different, as I think made that very, very advice, right, is absolute paramount to begin with. But the structures that you can go in with property and the wealth creation strategies that are out there, it's not just buying your investment property and your one residential property and things like that. We haven't really touched on commercial, which for business owners, your commercial properties in self-managed super funds and or family trusts are one of the best scenarios that you can do, and pay yourself rent and all sorts of scenarios there. So commercial is probably a whole new segment in what you can do there. Self-managed super funds, although they have rules and regulations, it is something that we have touched on. There is amounts in your super fund that you would need before you start exploring that, and I normally say that's around your $300,000-$400,000 mark before you start looking at a self-managed super fund structure for investing and things like that. But again, it is something that you can explore, especially commercial. Again, commercial in self-managed super fund is massive, because your business, if you have a business, can rent against yourself. It's a self-funded retirement strategy and things like that. So property can take so many different angles and so many different ways. And I think, I'm hoping what this session has done is opened the taxpayer's mind to not just the tax advantages that can bring, but your wealth creation side of it as well, and what you can do if you really start strategizing early and that sort of thing. So it's not really a question that hasn't been asked. I challenge your listeners to really put their mindset in play here, and have we changed your mindset about property? I've got a lot of clients that say to me, no, I don't like property, I want shares. But when they start talking to people such as yourselves, the mind shifts, and you see that little aha moment that they have the ability to do property and do the shares and everything on the other end as well. So I just hope that it has opened some people's minds to take some challenges and become educated on different ways that they can strategize and develop their wealth.
Awesome, Nicole. I think that was the best thing. If you want me to summarize the session, this was, that's the opening. It opened all the spheres, and it's all about mindset, right? And mindset and strategy start early. People think, hey, and Puru would admit that when we get people, hey, when I will have multiple properties, then I will look at trust. Then I will look at strategy. Hey, I'm just buying my first investment, or I'm buying my second investment, or I'm just buying a small commercial. I said, guys, there is help available. There are experts available. Go and talk to them. You won't lose anything. But after 5 years, don't come to me and say, I did tell you to check, but you chose not to. So please be aware. That's the least we can do as professionals. And I believe that's our moral responsibility as well, that guys, explore your options. And Nicole, amazing session. Because such a complex topic, finance and anything, you touched upon in such a simple way. And the stories that you shared, that were amazing. That resonates well with our audience. And I believe you will get a lot of questions as well, which me or Puru or Anubhav or Steph, she's just monitoring all the chats. We will connect with you. Great insight, Nicole. And would love to connect with you again. And probably we may run a session on just commercials and SMSF. So Puru, that's a key point as well, because that's a lot of education is required in that sector too. Over to Puru.
No, thank you so much for the time you have given us, of course. And this video will be shared back on the socials. We will make sure, and you please feel free to post your details about your business. What is the best way to contact you, etc. I can see that there will be a lot of interested people. And of course, I have been knowing you for a while now, and can't talk less highly about you, because I've seen your professionalism. We have served few clients together, and the value which we can bring together as an ecosystem for investors in property space is unmatchable. As an accountant, as a broker, as a buying agent, and the ecosystem is what enables people's confidence and propels them towards the magical wealth creation, which everyone is aiming for ultimately, right? So that's it from me. Yeah.
All good. Thanks, Nicole, and enjoy the rest of your evening.
Thank you so much, guys, for having me.
Thank you. Have a good evening.
Thank you. You too.
Bye.